All right, welcome. Today, we are diving into one of the most powerful and honestly simplest tools in trading, the trend line. If you can get this right, you'll learn how to read the story a market is trying to tell you. So let's jump right in. When you first look at a financial chart, it can feel, well, a little overwhelming. It's just a jumble of lines going up and down, seemingly without any reason. It really just looks like pure chaos, and it's so easy to get lost in all that noise. But what if I told you there's a surprisingly simple tool that helps you cut right through all of that noise? A tool to find the underlying pattern and bring a little bit of order to that chaos. Well, that tool is the trend line. Okay, so let's start with the absolute basics. What exactly is a trend line? At its heart, it's a beautifully simple concept. To put it simply, a trend line is just a straight line you draw on a chart. Its whole job is to connect at least two different price points. And when you do that, it gives you a crystal clear visual of the market's direction. Is it going up, down, or just sideways? Think of it like this. In an uptrend, the line acts like a floor. We call that support, that the price keeps bouncing off of. And in a downtrend, it acts like a ceiling, or resistance, that keeps pushing the price down. It's basically a visual map of the market's boundaries. And here's the funny thing. Trend lines are one of the most common tools you'll see in trading, but they're also one of the most underutilized. So many people draw them incorrectly, but when you do it right, they can be just as powerful as any super complex indicator out there. So what are we actually looking for on the chart? Well, the market really only flows in one of three predictable directions. A trend line is your key to figuring out which one is happening right now. It's pretty simple, right? Up, down, or sideways. Every single chart you will ever look at is in one of these three states. The trick is knowing how to spot them and, more importantly, how to draw the line that actually defines them. Okay, first up, the uptrend. This is what we call a bullish market, where prices are generally heading higher. The key thing you're looking for is a series of higher lows. That just means each time the price pulls back, it stops at a higher point than the last one. Your trend line connects these little valleys, forming a support floor. Then you have the exact opposite, a downtrend, or a bearish market. Here, prices are generally falling. What you're looking for now is a series of lower highs. So each time the price tries to rally up, it hits a ceiling that's lower than the previous peak. The trend line connects these peaks, forming that resistance ceiling we talked about. And finally, there's the sideways trend. This is when the market just can't seem to make up its mind. The price is just bouncing back and forth, stuck between a pretty consistent floor and a consistent ceiling. We call this consolidating. It's basically waiting to decide on its next big move. Okay, that's enough theory. The real power here comes from knowing how to actually apply this. So let's get practical. We're going to walk through exactly how you draw these lines on a real chart. This is probably the most important question, isn't it? Because listen, a poorly drawn trend line is actually worse than having no trend line at all. It can give you bad information and lead to some really rough decisions. So let's make sure that doesn't happen. It's really just a simple four-step process. First, just look at the chart. Eyeball it. Identify the overall trend. Second, find at least two major peaks or two major valleys and connect them with a straight line. Third, extend that line out into the future. This helps you project where the price might go. And finally, number 4, you have to be ready to adjust it as the market gives you new price points. Now pay attention, because this is the part people mess up all the time. For an uptrend, your line must go below the price, connecting the low points or the valleys. For a downtrend, the line goes above the price, connecting the high points or the peaks. It's that simple. Valleys for uptrends, peaks for downtrends. All right, now that you know how to draw them, let's cover a few essential rules. Think of these as the do's and don'ts that really separate the amateur chart watchers from the pros. Getting these right is what makes trend lines so incredibly effective. You can draw a straight line between any 2 points, right? That's just geometry. But in trading, a trend line isn't truly confirmed until it's been touched and respected a third time. That third touch is the validation. It's the market telling you, hey, you found a genuine trend here. And here are 2 more crucial rules to remember. First, be really careful with super steep trend lines. A line that's almost vertical usually represents some unsustainable panic or excitement, and it's probably going to break. Second, the more times a trend line gets tested, meaning the price comes down and touches it and bounces off, the stronger and more significant that line becomes. And that brings us to the single most important rule of all. I'm going to say this as clearly as I can because it is that critical. Do not ever force a trend line to fit where you want it to go. This is probably the biggest mistake you can make. The line you draw has to be an honest reflection of what the market is actually doing. If the peaks and valleys don't line up neatly, then guess what? There's no trend line there. You can't just ignore a price point because it messes up your nice, pretty line. The market tells you where the line goes, not the other way around. So there you have it. That's your guide to trend lines. It's a tool for creating a map of the market's behavior. By learning how to draw this map correctly, you can stop guessing and start listening to what the chart is telling you. So the final question is, now that you have the tool, where's the market telling you it wants to go next?